Hey folks, welcome back to the channel. Liquid here. We have a lot of important earnings coming out this week, and the Fed is announcing another rate hike. And on top of all this, we're going to get the much anticipated second quarter GDP number for the United States. And by the end of the week, I think we're going to have a much better idea of where we are in the stock market cycle. As you probably know, over the last couple of months, I've been pretty bearish on the market because I just see the stock market going lower and lower, and there was sort of no signs of it hitting a bottom. I've even shorted the market by selling 100 units of QQQ. However, recently I have noticed things starting to change, so I've actually become market neutral. I have basically bought back my QQQ and closed my position. So I am no longer short the market. I am now 100% long. And in the long term, of course, I want the stock market to go up. But in the short term, I am neutral because right now I'm waiting to see if the market will go higher or lower, depending on the technicals. And I'll tell you in this video why I'm neutral now. And I don't think that there is a lot of potential for the market to continue going lower. So looking at the S&P 500 here, since the beginning of the year, the market's been up and down, but mostly down. We haven't really seen a signal like we've seen in the last month. And this is what kind of makes me bullish, is the market has hit a low and it bounced up and down again, but it didn't go as low as the previous low. So we call this a higher low. And then it went up and down again. And then the last bounce up that it did, it actually surpassed the previous highs that it bounced from. So we call this a higher high. So basically we have higher lows and higher highs, and that is a bullish signal. And we haven't really had that since the beginning of this bear market cycle where the market's been going down. Since the beginning of like this year, the S&P 500 has been falling, and we did see a bounce here, but you can see that although it hit a higher low here, it did not go up to a higher high. There's still weakness in the market. And then we had this kind of low here, and we had a really strong rally here. And when it came back down, you can basically see that it actually surpassed the previous low. So that is not a higher low in this case. Over here, we had a high and then some sideways movement and then down. So that is not a strong indicator that the stock market has bottomed. And that leads us to basically over the last month where we had this pattern here. So this is probably the most bullish signal that we've seen in a while. And we can take a look at the technical indicators here. I'm going to look at the SPY, which can stand in for the index. During the short week, we can see there's actually quite a lot of bullish signals here. That's what all these green dots are. We have 7 bullish signals and then 1 bearish. In the medium term, we have 2 bullish and 2 bearish. So it's pretty neutral, medium term. And in long term, I think we're still in a downward trend. So there's probably going to be more bearish signals here than bullish signals. But market reversals always start with short-term turnarounds, and then they essentially, over time, turn into intermediate and long-term trends. Now, it's important to understand why we had a bit of a rally over the last month, especially over the last week. It was some really nice gains there. Basically, we've run out of sellers in the market to really have that selling pressure. So if we take a look at the fear and greed index, we can see right now we're at 39, which is fear, but it's closer to neutral, like it's not extreme fear. However, a week ago it was lower. It was at 26, which is like around here. And then 1 month ago, it was at extreme fear. It was at 22. When the market is that afraid, it can't really stay like that for too long because when people are afraid, they sell. But once you sell, you don't have any more shares to sell. So the only thing you can do the next time you trade in the market is you have to buy, and that's going to create upward pressure. And this is what investor sentiment is telling us as well. So basically, in early July, we had the bullish sentiment at one of the lowest points. Only 19.4% of investors thought that over the next 6 months, the stock market was going to go up. And this was the sentiment from even before that. So on June 22nd, it was 18.2. And here's what's interesting, though, is a lot of people think that bull markets are how you make money, right? But it's during bear markets where true wealth is actually created because investor sentiment is actually a very good contrarian indicator. So take a look at this chart here. Is the lack of bulls good for stocks? And in the long run, I think it is because this is how many percent of investors are bullish. So that's using the same metric as this website here. So from 1988 until now, we can see there were many instances where the percentage of bullish investors fell below 20, basically like the situation we're in now. Just take a look at maybe like 18, because that's sort of where we were on June 22nd for that week, 18.2. So if you look at 18, during that time in September 1988, after 3 months, the market was up 2.8%, and then 11% after half a year, and then 33% after a full year. Here's another 18% bullish in 1989, and we can see, let's just look at the 6 month down the middle here return of the S&P 500, 18%. So that's pretty good. This one here, 12%. So in the short term, it's not guaranteed you're going to get a positive return, but 6 months, that's a 12% return. That's in 1990. So you can see almost all of it is going to be positive, except for this 2008. But on average, I think you have a very high probability that in the next 6 months, or at least in the next year, you're going to get a positive and most likely a very high return. This chart is a little bit outdated, but the 6 month and 12 month, we don't know yet a lot of what this is going to be like for the April numbers here. So that's anybody's guess. But if you look at the pattern here, the median is up 12% over 6 months. So the other big thing that people are worried about is inflation. But I think inflation is going down now, or at least it's more tame. And the expectation of inflation is that it's going to head lower, because this is the 5-year break-even inflation rate. It's pretty much gone to what it was last year. So in July 2021, it was around 2.5, and it was higher this year, but it's gone down back to around 2.5 again. And if we take a look at commodities, we can see that oil has come down from the highs earlier this year, over $124 a barrel, down to below 100 now. So that's good. Natural gas, it went down, but then it's, for some reason this month, it's climbing again. So we'll have to keep an eye on that. Heating oil has also come down. If we take a look at some of the metals like gold and silver, they've come down as well from earlier this year. So this is going to lower the cost for making medical equipment and electronics, because a lot of them use silver and gold. And then copper, this is like a base metal, and it's just gone down. And this is really good. A lot of things require copper for constructions, electrical wiring. So if the price of copper is down, then we're going to see at least disinflation or lower inflation in a huge chunk of the economy, including labor services. For soft commodities, we have corn just falling off a cliff there. That's really good. Wheat. So it's good to see that, perhaps food inflation is not going to continue going, 10% a year or higher that we've seen so far. Live cattle, holding pretty steady. That's good. It's not continuing to go up higher and higher. Like, it's hard to say, but I think the worst is over. I think there's a good chance that right now inflation, at least CPI, is either at a peak or it's very close to a peak. So all of those things are making me think that this could be the bottom of the market back there in June. And that's why I closed out my short position in the markets. And right now I am holding a lot of stocks, and I am holding options as well. These are my largest positions right now. I had 400 TD shares before, but then I added 100 because I bought back in through a put option. That was the wheel that I talked about before, how you can basically make money even in a sideways market. I also gained 100 shares of Meta in the last month or so, and I picked it up at $160 per share. That was another put option that got assigned. I've been holding these shares of Amazon for a long time, but after the split, I now have 200 shares, so that's good. I actually just got assigned 100 shares of Google. It's funny because I had a put option that was set to expire at 108, and Google ended the day on the expiration date with a price of 108. So that actually got assigned just on the dot. I had 457 shares of CNQ before, but then I thought the oil market was too hot, and I wanted to take some gains, which looking back was actually a good move. That's the thing with commodity stocks, is when you see a parabolic move up, it's a good idea to take some profits off the table, because they work in boom and bust cycles. They're not like a Procter and Gamble or pipeline stock like Enbridge, where you can expect more predictable growth. When you're dealing with mining companies or energy companies, if it looks like things are too frothy, it's a good idea to take some money off the table. And also, like in 2020, I've talked about before, if it looks too good to be true, like when oil futures were actually negative, that's probably a really good time to actually buy into those companies. So I think my overall portfolio is well positioned for the next bull market move up. Now, everything seems pretty bullish that I've said so far for the stock market, right? If inflation is going down, then that means the Fed will probably raise interest rates at a slower pace, and that's good for the stock market. And also, just from a technical perspective, it looks like a pretty good chart here, at least in the short term. However, I said in the beginning of the video, I'm actually neutral right now in the short to medium term. And that's because although things are looking pretty good, I'm not sure if this is another bear market rally. And if after this, we're going to get another leg down that is even lower than what we had before, which looks like it was at the 3600 mark roughly. But what makes me kind of apprehensive about going all in at this point is the market still hasn't priced in a recession yet. And next week is going to be a game changer because we're going to get a better idea of what's going to happen with the economy and also with the stock markets. So, first of all, last week we had Snap release earnings and it was terrible. The stock basically fell like 40%, 39% plus a little bit in after hours. And that's because they just made less money than expected and future guidance didn't look very good as well. And of course, Snap makes a lot of money on advertisement. Facebook also dropped as well. You can see it fell 7.6% just in a single day. And also for Google as well, because they all make money from advertisement, even though they're different companies. Yeah, you can see almost down 6% in one day. And there was no news from Alphabet. It was just that Snap had really bad earnings. And that was kind of like a barometer for the rest of the advertising industry. So this upcoming week here is going to be a pivotal point because we have a lot of things going on. First of all, the Fed is releasing another rate increase, and there's an 80% chance that they'll increase it by 75 bips, but a small chance, 20%, that they could go a whole 100 bips, just like what the Bank of Canada did. So if they surprise the market with that 1% increase, then expect the stock market to not like that. And that is going to be on Wednesday. And the following day, on Thursday, you actually have the official release of the GDP for the second quarter. And that's going to be released at 8:30, and I believe that's Eastern time on July 28th. So that one's important because it's going to tell us if the US is actually in a technical recession or not. Because first quarter GDP was negative, and if second quarter is also negative, then we have two consecutive negative GDP prints, which means the economy is in a recession, and that's going to put the Fed in a tough spot. I actually think if we go into a recession, then the stock market is actually going to like that because it means that the Fed will likely be more accommodative of the markets and increase interest rates, at least slower, if not just completely stop. Because if the US is already in a recession and if inflation is coming down, then maybe they will just keep rates at where they are and eventually in 2023, maybe even cut them. And then the third reason why next week is going to be a big deal is because we have a lot of earnings from companies. We have Alphabet and Microsoft coming in just after market close on Tuesday, and then Shopify on Wednesday. So those will be some really large names to look out for. So from Tuesday until Wednesday, expect a lot of volatility in the markets. And then on Wednesday after the close, we have Meta reporting. And then the following day on Thursday is when Apple and Amazon release their earnings. So, two technology giants, but also a very good barometer of consumers. And then on Friday, you have some oil companies and some consumer staples and other companies. So this upcoming week looks to be quite busy. Expect a lot of volatility in the stock market. However, the good news is after all of this is over, so basically 1 week from now, we'll have a much better idea of like if the market has bottomed yet or if there's still more pain to come. And we'll know that because, if the earnings come in pretty bad for not just the companies that I've highlighted here, but also for a lot of consumer staples like McDonald's and Coke. If people are just not spending, if consumers are cutting back, it's going to show up in the earnings of these companies. So a lot of the unknowns will be known at that point. So that's why I think we'll have a better idea of where the market is going to go from there. Now, if everything looks good, then I think that would be a great opportunity to invest in the market, even if it does go down. Because if we're already in a recession, then the market is basically what it is, and it's probably not going to go down further. The market is forward looking. So that's why, there's a good chance that is the bottom, but we'll have to see. So hopefully that gives you some things to think about for this upcoming week here. And check back on Monday or Tuesday, where I'll be posting another video on my Google Options update, that challenge that I'm doing. So thanks a lot for watching, and until next time.